This is the full retirement case study breakdown of a married couple. The husband is 59 years old. The wife is 61 years old. They don't have children. They've got $3.6 million saved up in retirement accounts, and also they're expecting Social Security. Today, we'll see how to best plan for their retirement. To quote the husband, "I would like to know how much money I would get monthly based on what I have saved so far, so I can plan my retirement lifestyle accordingly." They have several problems that they're working through. One is they both enjoy their work and they would like to work longer. They both work in creative fields, but there are things getting in the way. The wife is in a relatively high position in her field, but her industry has been shrinking for the past 20 years because it has been migrating towards foreign countries. So there's a lot less jobs going on, and she is burdened with more and more administrative work that she just doesn't enjoy doing. She feels if her work was more focused on the creative work that she initially signed up for, then she wouldn't mind working longer. The husband's eyesight is also getting worse, which makes design work a lot harder. He feels he has 2 more years of productive work left before he is forced to retire. They happen to live in New York City, which is a very expensive city to live in. They do own a paid-off condo that's worth about $500,000, which is fairly modest for New York City. They also each own a private art studio that they do their work in that's worth about $280,000 each. It is expensive to maintain, but they would like to keep it in retirement in order to continue to have a creative outlet. And the plan is when they can no longer benefit from it, they would sell it to pay for long-term care expenses. The husband has invested in cryptocurrency when it was early, and it has done very well for them. It has grown to be $836,000, but the problem is it's become 20% of their net worth. The husband has done really well with cryptocurrency and would like to continue to hold it. The wife is more worried about the risk level. They know they have quite a bit saved up in retirement accounts. They have $2 million in pre-tax 401k and traditional IRA accounts. They got a good tax break when they made the contributions, but at some point, IRA is going to want their taxes back, and that's what the required minimum distribution is, and they're unsure of what that will look like. In terms of the kind of retirement that they envision, they want to continue to travel, and they want to travel even more. In the past, they have taken advantage of the wife's trade shows to travel together, where most of their housing and airplane tickets were taken care of. The husband just has to pay for his share of the plane ticket. If they happen to retire in their early 60s, they want to travel a lot more before they're 70, and they envision spending about $30,000 a year. And once they're in their 70s and 80s, maybe calm down a little bit and spend around $15,000 to $18,000 a year. They do overall feel like they are in a decent place, but they want a confirmation from a professional. They actually work with a financial advisor right now who manages a decent chunk of their retirement savings. But in the past, when they've asked them retirement-related questions, the advisor seems much more investment-focused, and they just wouldn't be able to get a clear answer from their current financial advisor. Without clarity on if they have saved up enough money for retirement, here's how it affects them. They're working longer because they're not sure if they have saved up enough money. They are planning to work until age 62, until they can both start getting Social Security. I got clarification that they don't have an issue with starting later, potentially even up to age 70, but he does see a lot of news about Social Security getting cut down the road, so that was influencing his decision to start earlier. And they also wanted to know if they were to retire earlier, how do they bridge that income gap from when they retire at early 60s to starting Social Security at age 70. When I asked the wife if she would feel more empowered negotiating a better working arrangement if she knew she could walk away and just retire, she said yes. So working with me, and throughout this video, we'll talk about how much money they can spend in retirement, when they can retire, what to do with their cryptocurrency, and can the wife afford to go part-time. But before we dive into all that, a little bit of disclosure. My name is Jason Koh. I am a certified financial planner with over a decade of experience. I am the founder of the Fiduciary Asian Advisor Network. I do discuss specific investment recommendations and planning recommendations that I gave this particular client, but that is after we've gone through a lot of work together to really customize it for their needs. This video is for educational purposes only. I'm not making any financial recommendations or investment endorsements to you. So please do your own due diligence and work with a CFP professional when making tax, investment, and retirement planning decisions. You can find your own CFP at FAAnetwork.com or scan the QR code next to me. Let's start by looking at where they are today in terms of their assets. They have a decent amount of cash, about $115,000. The husband's traditional 401k, he has $989,000. The wife has $439,000 with a combined total of $1.4 million. They had old 401k accounts that they rolled over into a traditional IRA account with a combined total of $536,000. So between the 401k and traditional IRA, they have about $2 million in a pre-tax retirement account that would be subject to required minimum distributions. Roth IRA, they have $186,000. The taxable account, there's about $104,000 that the husband self-manages in individual stocks, and the joint account is managed by their financial advisor, about $377,000. The ones you see in blue here are the ones managed by their financial advisor today. And when I dug a little deeper into it, I also saw that the advisor was accounting for the fact that they had a large 401k balance when making the investment decisions. So I do consider the total combined amount of $1.4 million to be under the advisement of the financial advisor. The husband has $836,000 at Coinbase under cold storage. The breakdown is primarily Bitcoin, some Ethereum, and some Solana, and a lot of other smaller alternative coins. With cryptocurrency, even though it is a large amount, 20% of their net worth, because the husband has seen it grow significantly, he feels that even if it drops by half, he's still in the green in terms of his original cost basis, so he still feels good about holding it. And this is a fairly common phenomenon that we see where people anchor their investments based on the price that they get in and out of. But because the wife didn't know when all this happened, she just sees that there's $836,000 in a very risky investment. So I fully understand where they're both coming from when it comes to their unique risk tolerances around the cryptocurrency. There's $78,000 of physical precious metal. That is not a large enough amount that will cause me to be worried. Overall, they think their advisor is doing a decent job. They've worked with him for a while now. When I looked under the investments, there's a 70-30 mix overall. The client says the advisor charges 0.8%, which I think is very fair given what the advisor is doing. We'll dive into that a little more later. For real estate, they have $500,000 in their personal residence and a little over $500,000 in both of their art studios. There is a mortgage on the husband's art studio worth $160,000, and that's one of the recurring conversations that we have about how to pay that off over time. So let's do a review of what the advisor is managing for the client. And the full portfolio includes the 401k that is managed by the client and the IRAs, Roth IRAs, and a taxable account that is managed by the advisor specifically. And when we add all of it together and look at the investment mix, we see a 69% stocks and 31% bond mix, very close to a 70-30 mix, which I think is a really good starting point for the client. And seeing this mix, even though he's not technically managing the 401k, this was the first sign that I saw that this advisor is doing a really good job for the client, because it takes extra resources, it takes extra time to account for outside assets when making investment decisions, and the advisor is taking an effort to do that. When we look at just the traditional 401k and the traditional IRA that the advisor is advising on for the client, you'll see a heavier bond mix in these accounts, 41%. And this is the second sign that tells me this advisor is really caring about the tax efficiency of his investment recommendations. When we look at the joint taxable account that he manages for the client, 100% is in stocks, which is the right thing to do. And I really like it that this advisor has 100% US equities in the taxable account, because that would mean the large majority of the dividends that the clients would receive and have to pay taxes on each year is taxed at the qualified dividend rate, which is the same as the long-term capital gains tax rate, which is anywhere from 0, 15, or 20%. The Roth IRA is where he puts everything else. It's 100% in growth type equity. The international stocks, maybe not as tax efficient as US stocks, and he does a good job of strategically placing each unique investment, each asset class into the right account types. So I told the client that I think this advisor is doing a really good job for them. Now, to be a little nitpicky, there are some things that the advisor can do for them to lower the cost of investments even further and improve the client's outcome just a smidget. This is the screenshot from the client's actual statement holdings with their current financial advisor. And you'll see these investments are iShare ETFs, Vanguard ETFs. I'm a big fan of ETFs overall, but a lot of these were older funds, and older ETFs just aren't as cheap as the new ones that have come around the past 10 years or so. So I'll start off by talking about the bottom here, IWB iShares Russell 1000 Index ETF, which is an index comparable to the S&P 500. It is invested in the largest 1,000 companies in the United States stock market. This is all held in the taxable joint account. And you'll see here, this client has been working with this advisor for a while now. The cost basis is $126,000 with a market value of $375,000. There is an unrealized capital gain of $249,000 basically, and it doesn't make any sense to recommend the client to sell this fund to invest in a lower cost ETF that invests in the S&P 500 or total US stock market, because the marginal benefit of making that switch would be so little, but the taxes would be so high. So I focused my effort on making recommendation changes in their retirement related accounts where the changes are not taxable events. And when we look at these ETFs, there are 4 that can be switched to equivalent investments with lower costs, and it would lower their investment costs. iShares Cohen and Steer REIT ETF is one of the earlier real estate investment trust ETFs. The expense ratio is 0.33% a year because there is $109,000 invested in it. If the clients switch over to SCHH, the Schwab US REIT ETF, the expense ratio is 0.07%, translating to an annual savings of $284. Same for iShares EAFE ETF. This is the Developed International Stock Market Index ETF, has an expense ratio of 0.32. There is something that they could find provided also by iShares that is 0.07%. That's even more diversified. iShares Russell can be switched over to the S&P 500 ETF at 0.02%. Russell 2000 ETF switch over to S&P 600 small cap ETF for 0.03%. And you save a few $100 every year, and that will translate to an annual savings of $969 a year. And the good thing about making this switch one time is that going forward every single year, you're saving this kind of money, and the savings will only grow over time as the investment balance grows. I also spent some time to review the advisory fee that the client is paying their financial advisor today. Now, the client is expecting about a 0.8% a year fee, but I was not able to reverse engineer that number. What I was able to figure out was if we added all of the investment accounts that the advisor actually manages on a day-to-day basis, it's just over $1 million. And I could see from the individual statements, the annual fees, it adds up to be $13,320 a year, and that translates to 1.27%. Now, this is higher than 0.8%, but because the financial advisor also advises on the 401k balances, if we add up the 401k balance for the husband and the wife, the advisor is actually consulting on $2.5 million. If we use the same $13,000 a year fee, that translates to 0.54%. So again, I think this advisor is doing a really good job. 0.54% or 1.27% is a fair price for the in-person service and the customization and tax efficiency that the advisor has been able to do for them. Now let's look forward a little bit and look at the husband's Social Security down the road. If he starts Social Security at age 70, it will be $4,697 a month. If you start at 62, it will only be $2,570. So it is a big discount here. He would have an additional 8 years that he'll be getting extra income on, so we'll have to account for that. But one caveat is with them being early retirees, they may not be contributing their higher income that they're earning today into the Social Security system. So their Social Security at age 70 may be lower than $4,697 because Social Security assumes that you're working until age 70 when they give you this kind of projection. For the wife, we're seeing similar numbers here. Since the husband and wife were both high income earners, they're maxing out their Social Security benefits. The wife is getting similar amounts at age 62 and at age 70. If we do the math and assume both of them start at age 62 versus both of them starting at age 70, we'll see a big difference here. For the first 8 years, if they started at age 62, they would be getting some income for the first 8 or so years, but the income level is capped for the rest of their lifetime. If they figure out how to meet this income gap for the first few years of their retirement and delay until age 70, they do miss out on several years of income, but their income starting at age 70 for the rest of their life will be higher. And assuming that they both live to age 95, you're talking about more than $1.3 million extra of lifetime benefit. Now, the likelihood of a married couple with one of them living past age 90 is actually quite high. If we look at the total combined benefits at each age, you'll see the break-even point for them of starting early versus starting at age 70 is at 78. If they expect one of them to live past age 78, then it makes a lot of sense for them to delay to age 70. And I really like this strategy for them because starting Social Security at their maximum age of age 70 would mean for the rest of their life, they will have a much larger percentage of their spending needs be guaranteed by the US government, guaranteed to track inflation. They just have to figure out what to do for the first 8 to 10 years of retirement, and they're kind of set for the life because you only get to keep one of the two incomes when you pass away. The more you delay, the higher the benefits during your lifetime, and also the higher the benefits for the widow if one of them were to pass away earlier. The required minimum distribution is also a concern of them. The client is aware they have close to $2 million in tax-deferred assets. These are your traditional 401k, traditional IRA. And down the road, when they are 75, they would each have to pull out the required minimum distribution, which will be about 4.5% starting out and grow over time as they get older. because we have all of their income and expenses and their assets. In our planning tool, we can actually map out what their future may look like. This is a very poor projection, but it's the best we've got. And we can see this big dip of when they're still working. They're at a very high tax bracket, over 30%. And as each of them get into retirement, they hover around 15 to 10% in total tax rate when you combine federal and state. And it spikes up again when the wife turns 75 and the husband turns 75. So this dip here is what we call the tax planning valley. Let's make a projection of what their retirement may look like if they made certain strategic choices. The blue is what we saw in the earlier part. This is only showing the federal tax, and you'll see this valley here from the previous page. If they were to convert part of their traditional 401k and traditional IRA to their Roth IRA while they're in this tax planning valley, they would be front loading their tax bill and reducing what they would have to pay down the road. This is something difficult to project out 5 years in the future. It's really something we need to be doing an annual projection to see how much room they have in their income to make Roth conversions without running into issues of increasing their health insurance premiums through Affordable Care Act significantly, or down the road through Medicare significantly. So this is just an overall idea that I wanted to introduce the client to, that they have some control over their RMDs down the road, but this is something they would have to work with a financial advisor on an annual basis to make the accurate projections of how much Roth conversions to do every single year. So let's start to answer the questions of how much money that they can spend. Right now, their income while they're still working is $165,000 for the husband, $200,000 for the wife. For their expenses in retirement, they're hoping to spend about $192,000 a year or $16,000 per month. Again, they want to front load a lot of their traveling before they turn 70 and then maybe scale back down once they turn into their 70s and 80s. Some of the larger expenses that they have on an ongoing basis is for each piece of their real estate, it's about $800 per month. So $2,400 per month for all three of them. They're also starting to get special assessments on their properties. It hasn't happened for the past decade, but in 2025, they got hit by a big bill of $19,000 to make some random repairs on their home. If they choose to be early retirees before 65, they got to project at least $1,500 per month for health insurance and extra for that $1,000 per month out of pocket just to maintain good health. My recommendation for them was to build a bond ladder that perfectly matches their spending needs for each specific year. What you see here is the specific maturity date for these target maturity bond ETFs. For the one maturing in October 2030, it's intended to be used for the year 2031. For the first 5 years of their retirement, we're hoping to get $180,000 that matures. Then as Social Security starts to become available, and once they get into their slow go years in their 70s, their spending needs go down to $140,000, $110,000, $100,000, and $80,000 once Social Security fully kicks in for the both of them. What I like about using bond ladders is that you don't have to worry about what is the right percentage in bonds and stocks anymore. When we add up all of the bonds that they need to be buying today, for the first 3 years, they need to be buying it now. After retirement and they roll over their old 401k into an IRA account, they can have money to buy more bond ladders. And in 2028, they need to buy the final 10-year bond ladder for themselves. When we add up all of the bonds that they are recommended to buy today, it is $1.41 million total, or 43% of their total investable net worth invested in bonds, and the rest into stocks. If you recall from the earlier slide, they are at a 70-30 mix, meaning there's 70% in stocks and 30% in bonds. So I am recommending for them to have a higher level of bonds right now. And that perfectly aligns with their desire to travel more in the first few years of their retirement. And when they get their Social Security, the total number of bonds that they would have goes down. And in 2036, when their annual withdrawal rate from their investment portfolio goes down to about $80,000 in today's value, that means that they wanted to have a 10-year bond ladder, they would have a total of $800,000 in today's value invested in bonds. So it's quite counterintuitive. In fact, as you get older and you have other sources of retirement spending coming in like Social Security, you can actually afford to be more aggressive over time. So the core scenario we have modeled out, the wife starts to work part-time in 2026, and they both fully retire in August 2027. They spend $120,000 a year on top of their housing and on top of their health care, which is $200,000 per year total. They claim Social Security at 70, and when they each turn 85, they will be selling their art studios to fund long-term care expenses. And we come out to a 89% probability of success, or an 11% chance that they would need to make a lifestyle adjustment downward to make their money last for the rest of their life. We come to this conclusion by modeling out all of the base assumption and creating 1,000 different versions of them. And some of them live through very good stock market returns and bond market returns, and some of them live through very poor stock market and bond market returns. And the large majority of this scenario shows that they can make it through retirement with a low chance of running out of money. So that's very positive news. But this kind of projection is not all that useful when you're looking at a time frame longer than 5 years. This is like a flashlight. The further you are away from the thing you're shining, the less clarity there is, the less bright the future looks like. So this is something you need to be reassessing every few years or so. This withdrawal rate chart shows what percent they are pulling out from their retirement savings every single year. Before age 70, two things are happening. They're spending more money traveling around the world, and they don't have Social Security to rely on. So there is a higher withdrawal rate, even getting close to 8%. That is typically not recommended for retirees. Most advisors and most DIY retirement planning folks use a 4% rule. That's really not realistic for most people. If you're 95 years old and you still have a couple of $1,000,000, you can probably afford to spend a much higher percentage than 4%. Now, the 7 to 8% range is not something I would recommend long term to sustain, but if we can secure all their spending needs in a government guaranteed treasury bond, then we're not as concerned about the fluctuations, the ups and downs of the stock market before they turn 70 and have Social Security income. Once Social Security kicks in, their withdrawal rate hovers around 3 to 4%, which is a very sustainable withdrawal rate over the long term. This year it spikes down because they're staying at their condo and they have an income flow coming in. And as they get older and their retirement spending is less, their withdrawal rate goes even lower. And in the last 4 years, it spikes up because we're assuming each of them needing 2 years worth of long-term care support. I ran a version of their scenario that assumes that the wife fully retires today, and it reduces their probability of success from 89% down to 83%. Now, the wife is a little concerned seeing this. She doesn't feel as confident walking away from her job after seeing this. But I told her the $200,000 a year of spending for their go-go years in retirement, we just assume it lasts for the rest of their life. So I'm not that concerned about the 83% probability of success. What this does suggest is that if she were to be in a very uncomfortable position at work and she really wants to leave today, she can afford to and they can make the numbers work. So it's been about a year since I worked with this client. They walked away knowing that they have the flexibility to retire at any time. Right now, they're still both working full time. The wife feels that part-time work option is just not as viable. The industry is very difficult to be successful in. She feels her company is very lean and holding off on hiring new people and also trying to expand business at the same time. She hasn't talked to her boss about reducing her hours in the next 2 years because it's just a really tough economy right now for her industry and it doesn't feel like the right time. They've chosen to stay with their current advisor, which I have no problem with because I think he's doing a really good job with the investment management portion. I do wish to see they have a higher percentage of bonds instead of the current 30% to 40% because they do have the highest risk of spending out money when the market is falling in their first few years of retirement. Over the full planning engagement, the client has scaled down his cryptocurrency, and by the end of the engagement, he went from $860,000 in cryptocurrency down to $470,000. And with some of that proceeds, he was planning on paying off the mortgage of $160,000 by the end of 2025. It was really fun working on this case. I hope you learned something. Thanks for watching.